everybody recognizes it. It's like, well, I don't see how is this 100-to-1 gold silver ratio, and how can gold be all-time highs and silver still be 30% below its all-time highs, and all. Everybody sees that, but it's like, I'm not going to fiddle around with trading silver or anything like that until I see it breaking out, because otherwise, for the last 14 years, it's just been sitting here. So silver needs that moment of inertia. It's still fighting, the banks and their short positions, and I mentioned the commercial short positions in gold going down. Well, they're adding it on in silver, trying to cap it, so they don't get squeezed. Once silver starts to take on that momentum and it starts to go, back in 2011, it got from 18, and then a month later it was 28, and then a couple months later it was 38, and then a month later it was 48. That inertia is applied and it starts to accelerate.
June was one of silver's strongest months in recent memory, with gains coming during a typically weak seasonal period. This rally is further supported by rising demand for silver ETFs, which is now outpacing gold ETF inflows, indicating growing investor interest from outside traditional sectors. Craig Hemke, founder of the TF Metals Report, notes the market has accumulated a physical deficit of nearly 700 million ounces over the past 4 years. Despite these bullish fundamentals, silver prices have not yet reflected the tightening supply, remaining significantly undervalued compared to gold. Global silver mine production continues to decline, with 2025 output projected to be 7.23% lower than 2014 levels. Since 2019, the silver market has faced persistent annual deficits, and 2025 is expected to see another shortfall of approximately 117.7 million ounces, highlighting a growing imbalance between supply and demand. Hemke believes the strength could signal the start of a broader move into silver, especially given the distorted gold-to-silver ratio. With gold near record highs and silver still lagging, silver's catch-up potential is substantial. On Friday, silver traded sideways at $36.84 per ounce due to low volumes during the U.S. market holiday. Still, concerns over renewed trade tensions following the passage of the One Big Beautiful Bill kept market sentiment cautious. Technically, Hemke sees silver nearing a pivotal point. Monthly and quarterly closing prices are approaching levels not seen since 2011. A sustained breakout to all-time highs could attract institutional capital and ignite a significant rally, bringing long-awaited recognition to silver's critical role in both investment and industrial markets. Before we dive in, don't forget to like, share, and subscribe to our channel to help us reach 1,000 subscribers as soon as possible. Only 2.3% have subscribed so far, so hit that button and tap the bell icon to stay updated with all our latest insights.
Physical supply-demand dynamic is clearly manifesting itself, at least even in the current structure of price and how price is discovered. And what we all wait for is, this kind of breaking point. What did Andy was $700 million or 700 million ounces physical supply deficit over just the last 4 years alone, and we've got to be at this, I don't see where that's slowing. We're not increasing mine supply. And again, so much of silver mine supply comes from mining of copper and zinc and all these other metals anyway. But you get to where the demand, the physical demand, whether it's from investors, which is still, not that great, but from industry, and not just, U.S. industry or whatever. Global industry, whether it's solar panels, these, Samsung EV batteries that might be able to quadruple the life of an EV battery that's mainly based in silver. There's a point coming, and I think we'll see it when some company just says, like you said, Andy, they're just going to take it all in house. It's like there was a point coming for McDonald's when they finally said, you know what, we're going to have to grow our own potatoes, and they do. Right? They said, we're not going to take, we're just going to go straight to the source. We're going to grow our own potatoes, and we're going to build our own rail lines, and we're going to do our own processing plant. We're not just going to buy the finished French fry product and put it in our fryers. And that's coming for silver. Someone, whether it's at the sovereign level or whether it's a big company, is going to say, look, we just can't take it's one of multiple components of our product, but we can't build the widget if we don't have all of the product, all of the components. And we're going to have to take this in house. And when, that kind of thing starts happening, that might be the one that sets off a rush as well. But in the interim, silver the line I like to try to explain to people is silver is like, what is it? Newton's law of momentum or whatever it is. Andy, I should just look this up so I can spout it, chapter and verse and not look like such a dope. But remember, an object at rest remains at rest until force is applied to it, right?
Yeah.
It'll just sit there, but something's got to shove it. And then it's like a rock falling down a mountain. It'll just sit there. But if you give it a shove, away it goes. That's kind of what silver's like. Everybody recognizes it. It's like, well, I don't see how is this 100-to-1 gold silver ratio, and how can gold be all-time highs and silver still be, 30% below its all-time highs and all. Everybody sees that, but it's like, I'm not going to fiddle around with trading silver or anything like that until I see it breaking out, because otherwise, for the last 14 years, it's just been sitting here. So silver needs that moment of inertia. It's still fighting, the banks and their short positions, and I mentioned the commercial short positions in gold going down. Well, they're adding it on in silver, trying to cap it, so they don't get squeezed. Once silver starts to take on that momentum and it starts to go, back in 2011, it got from 18, and then a month later it was 28, and then a couple months later it was 38, and then a month later it was 48. That inertia is applied and it starts to accelerate. Well, that's coming. And the last thing I'll add to that, because again, I could just go on and on. For everybody listening, recall gold, ran up to about $2,000 an ounce in response to COVID and everything, and then went sideways for 3.5 years under $2,000. And everybody's just waiting, and debt continues to accumulate and all this stuff is just going sideways. Well, then finally, right at the end of 2023, it begins to break out above $2,000. New high monthly close, new high quarterly close. And then once we got, really got breaking out on the 1st of March last year, 2024, took off through 2,100. Immediately went to 22. And then within about 6 weeks, it was 24. And it's just been ever since. Well, silver's got that moment coming too.
Craig Hemke has consistently argued that, regardless of manipulation or volatility, the most innovative approach remains unchanged. Think long-term and steadily accumulate physical silver. In his view, physical ownership isn't just a hedge. It's a safeguard against an eventual monetary reset and the continued devaluation of paper currencies. Silver has long been viewed as one of the most heavily suppressed commodities in financial markets. The steep decline in 2011, from over $50 to nearly $11, followed by years of stagnant prices, has led many experts to believe these weren't natural market movements. Instead, they suggest the price was deliberately pushed down by major institutional forces aiming to stifle enthusiasm and disrupt upward momentum. Hemke encourages retail investors to take a page from institutional playbooks by using periods of weakness to build their holdings. While the short-term price action may be frustrating, he believes that accumulating real metal during dips offers a rare chance to position oneself before the broader market wakes up to silver's full potential. In a financial system under strain, silver stands as both a defensive and strategic asset. Let's get back to the interview.
And I would encourage everybody to go back and look. I don't know where it's going to be, but at the end of June, silver is very likely to have printed a new for at least a new monthly closing high going back to 2011, like October of 2011. It's not going to do a new monthly all-time high. That's up at the end of April 2011 at 48. Now, silver is also getting close to painting a new quarterly all-time high. Probably didn't happen here in the second quarter, but we're working on it. That's about 37.60 or something. Now, I mention that because, again, that's all part of the momentum. Traders will sit there and, look at the hourly charts or maybe the daily chart. But the really big institutions, and we're talking, it's still a pretty small market. The home offices, the hedge funds, they're going to be looking at the long-term chart like they did with gold. And when gold broke out, what did we do? 15,000, 16,000 contracts in May. So that's about 80 million ounces. Again, though, that's 3, 4 times, 5 times what it used to be. And again, because if you can't get it timely out of London or any place else in the world, then hell, you show up in COMEX, buy yourself go long, fully fund that thing, and then just wait and, take your delivery. But it's gradual. No one's showing up, and there's not going to be 100,000 contracts still open, that kind of thing. And again, there's kind of a disservice that gets done because, I've been doing this long enough that you get a little more realistic about things. But I still see stuff on Twitter, people are like, oh yeah, to the moon and all that kind of stuff.
Yeah, really.
Well, I mean, I can make a case, sure. Yeah. I mean, $100 silver at some point, but it's not going to go from 38 to 48, well, once we get through 36, the next resistance is 48. Well, no, actually it's probably going to be those stairs that you're talking about. That's just kind of how it flows. It's like 2 steps forward and 1 step back. We're making progress, and the leverage of the system continues to get stretched and stretched and stretched. And like I said, those underlying physical supply demand fundamentals are irrefutable. And so it's definitely changing the rules of the game. It precludes the banks from just comfortably sitting there spoofing in their contracts, and applying massive naked shorts and then, running the stops and then covering them back up, and all those games that those precious metals desks have played for decades. It precludes them doing it indefinitely because, again, as that ECB note regarding gold, I mean, you begin creating kind of a systemic risk, not only to the system, but to your individual bank. And so as those games wind down and stop getting played, well, then again, we're moving that much closer to a...
Often overshadowed in mainstream narratives, silver is beginning to shake off its long slumber. With mining output shrinking, investor appetite climbing, and pricing still trailing behind historic norms, the metal is quietly building toward what could be a defining moment. Mounting physical deficits, surging ETF interest, and technical signals approaching breakout levels all indicate a potential inflection point. Yet, despite compelling fundamentals, silver remains treated as a fringe asset. For those watching closely, the question is no longer whether the market will reprice silver, but when it will. As silver inches toward a breakout, will institutional capital finally legitimize what retail investors have quietly understood all along? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.